To HCL Technologies and C Vijayakumar, the CEO and MD, as well as Prateek Agarwal, the CFO of HCL Technologies, are with us on the show. Thank you so much for taking time out. To begin with you, Mr. Vijayakumar, you said that in the call that you're bullish on the demand environment now versus what we saw at the start of the year. This comes despite the fact that we are seeing macro headwinds, especially emanating from Europe. So what's driving this confidence on demand?
Great that you caught that point, and I want to reiterate that I feel more bullish about the overall demand environment. And if you really break the demand environment into two segments, one is the change the business and transformative kind of spend, and the other one is run the business. What we traditionally saw was, of course, there was a huge acceleration in the transformation spend over the last 5 quarters. But if you dig a little deeper, a lot of transformation was they first take out cost to reinvest in transformation, or construct transformation programs which eventually provide some lot of business advantages along with the reduced operating costs, right? So these two are quite intertwined, right? Cost reduction and cost optimization and the business transformation. So at this point, while some of the discretionary spend might be put on hold or things like that, but there are a lot of big deals which are where you take over a significant amount of IT landscape, modernize and then transform. And the eventual outcomes are both better business agility and lower operating costs.
So CVK, given that you are so bullish, is there a case then that you can overshoot your 12 to 14% growth guidance, or at least, aim for something toward the higher end of that range?
That's something we stay with the guidance. It's only 1 quarter down the road. It's 12 to 14% is what we reiterated. And we continue to give you the messages based on what we see in the market. And I said it's better than what I saw in the previous quarter. So I think I would want to just stay with that.
Prateek, there seems to be a bit of a disbelief on the street around the ability to end up at the lower end of the margin guidance of 18 to 20%, specifically on account of impending wage hikes and the P&B seasonality. What is the magic bullet you have for crawling back margins, which analysts are underappreciating?
See, we have stayed with the same guidance because, it's just 1 quarter since we gave the original guidance. Just like on the top line, you were asking about whether we'll be on the higher end. On the margin guidance, we came out and told you very clearly that we expect to be towards the lower end. So we did not change the guidance because for the simple reason that, we want to see the first half of the year before we kind of tinker around. Having said that, there are a bunch of levers that we have. And, it's a 3-barrel gun, like I spoke yesterday as well. So 1 barrel of the gun is, increases that we are working very assiduously with our customers to get on the top line. The second one is obviously the fresher absorption and billing and the pyramid optimization. And then, as you saw, outsourcing cost and subcontracting costs have gone up about 100 basis points in the last quarter. That is happened in some of the newer geographies, focus countries and newer frontiers that we have been accessing. And that is the third barrel of the gun that we are aiming to get our margins higher. Apart from that, the normal ones like offshoring, automation, there are all these levers. As far as wage increments are concerned, the fact is that, we have managed it successfully for years together. We do split them kind of half and half between Q2 and Q3, which makes it more manageable. and our profit improvement programs, which keep running every quarter, have started in Q1, will definitely pick up pace in Q2, Q3, which we hope will offset those wage.
Pratik, so what are the chances that the exception of achieving lower end of the guidance becomes 17 to 19? I mean, what we're trying to understand is that if you do move to the lower end of the guidance also, that also in a sense could be a stress indicator.
Yeah, so I don't want to guess what we are going to say next quarter. I'll leave that for next quarter. But fair to say that, I think we have been living through the entire previous 4 or 5 quarters in an environment where a lot of the corrections have been done for a lot of people along the way. So it's not as if, it's not a normal year, right? I mean, it's not as if everybody has to be given an increment at the same time at what we used to do based on other years, especially in a year when things have been done during the year.
Hi, Pratik. Good morning. So when we see attrition rates also higher by, up by about 20%, the net headcount addition has come down very sharply. Now, this is one of the important indicators of where you see growth. How much should we read into this, and juxtapose it with demand?
Not at all. And the reason I say that so confidently is, we just talked about the margins, right? So we are obviously balancing the various levers, and we have been investing in hiring much ahead of the curve for the entire last year and maybe 5 quarters, 6 quarters now. And therefore, if you look at our headcount growth on a year-on-year basis is 19.5%, and our services growth is 19%. So it's pretty much in line, it's 0.5% higher. And we have continued with the fresher hiring. It was 6,000 plus in this quarter, even though the net headcount growth was 2,000 plus, the freshers hired were 6,000 plus. We've already given an indication for the next quarter, it is 10,000 plus, 10,400 odd. And talking about leading indicators, I think the very simple thing is look at our deal wins, which is 23% increase year on year. Look at our pipeline, which is very near the highest that we've ever had, which was just a couple of quarters back, etc. And the headcount growth, in my mind, continues to be very robust. Obviously, there is a margin challenge, and we are sort of balancing the various parts.
Pratik, we really appreciate your time. Thank you for joining us.